Hey everybody, how's it going everyone? Can you guys hear me in the YouTube chat just before I start and get into it here? Can I get a quick audio and visual check? You guys know my internet sucks. Okay, seems like we're good. Welcome to the Capital Hungry Monday Market Analysis webinar, where we will be breaking down fundamentals as well as technicals and some trade ideas on the main trading instruments that we trade day in and day out. Understanding the positioning we're looking for as manual retail traders, keeping our trading psychology in check, and mapping out and doing analysis ahead of time to ensure we always follow a strict plan when it comes time to execute. Okay, perfect. So I'm just gonna take my time here and let's just jump into it with some of the key fundamental points that we have to focus on first. Okay, so this is going to be an extremely busy and hectic week, so keep that in mind. In my opinion, as a manual retail trader, especially someone who may be inexperienced, this week is a perfect week to sit on the sidelines and observe and learn. But those who have a bit more experience, if you understand the fundamentals and can play that accordingly with some of the trades we're going to be potentially mapping out, then you can really take advantage. But understand overall, it is going to be a pretty hectic and busy week as we are starting the new month, coming towards the end of the fiscal year. We also have the Federal Reserve interest rate decision this week, and the US NFP and overall jobs market data this week, with some other central bankers giving their monetary policy statement this week as well. Okay, so overall expect a lot of volatility midway through the week into the markets, with FOMC, NFP getting this new month up and running as well, and expect a lot of liquidity grabs and price grabs to set up order flow for this new monthly candle after we go into the next fresh week. All right. Overall, though, markets are very optimistic and continuing higher, with equity still relatively bullish and Japanese yen and volatility index flat. The only other difference is the world reserve currency and business currency US dollar has been holding some more intraday bullish market structure, as we have had investors over the last few months start to price in the tapering signals by the Federal Reserve. Now, if you remember last FOMC, the Feds were giving us signals that they can potentially start the tapering in November. So now this week is where we're going to get that potential signal if they're really going to start the tapering process, and if economic data has rebounded and they don't see as much COVID fear, more people are getting vaccinated, and we don't have the US go back into a lockdown state. It does seem like they're on schedule to start tapering, but at the end of the day, it's the Federal Reserve. I wouldn't be surprised if they throw a curveball to really set up for the next FOMC after giving these signals of, oh, November we're going to taper, November we're going to taper. I would not be surprised to see a price setup on something like gold or the US dollar where they say, oh, we're not near tapering yet, maybe the next one, but we do have all this XYZ criteria met. The economy is a lot more robust, and it's really just going to be a curveball to set up for the next FOMC when they really confirm the tapering, in my opinion. But we'll talk about that in more detail, so don't worry about that. In terms of economic events impacting the market and our intraday periods here, we don't have anything through the Asian session tonight, but at 4:55 a.m. Eastern, if you're trading London session and trading any euro pairs, make sure you keep in mind for the Germany manufacturing PMI, which in my opinion will be a bit weaker data as well. Then the following day at 5:45 p.m. Eastern, we have the New Zealand employment change. So tomorrow is a little bit softer in terms of economic data and volatility, and this webinar right here today is primarily going to be analysis and trade ideas to use for Asian session, London session coming up, and tomorrow, with a lot of the volatility coming on Wednesday, Thursday, and Friday, with of course Fed interest rate decision and NFP at the end of the week. Okay. So now, when we're looking at and analyzing overall market sentiment and investor behavior, besides the US dollar, which has been bullish on the intraday timeframes for the last few months, primarily due to the impacting factor of the Fed's slowing down the stimulus, potentially looking at tapering off the stimulus support, and even giving some rate hike schedules in the future for 2023 potentially, we can see that we've had the reverse impact on the dollar after having such a long bearish run during the period of stimulus where the dollar was so heavily oversupplied. What we have been primarily been playing since July FOMC is the US dollar upside bullish market structure, where you can see we have buyers continuously print intraday highs. We have some fairly aggressive pullbacks. Before continuing to the overall upside there. Okay, so what I'm looking at when I'm looking at the US dollar movement is that for the start of November, we have already seen a heavy liquidity grab at the last day of the business month last week that came down to retest bullish market structure and potentially snap above this corrective bearish market structure. You can highlight every single time we have these highs printed. So the transaction between buyers and sellers is we have buyers extend and print these highs, take profit from these intraday price points, sellers jump in the market to relieve them out, creating this pullback in corrective phase, which really just pushes price down to a more favorable demanded price point to collect those big boy institutional buy orders and continue up to the previous high and potentially higher. What I'm looking to confirm this overall bullish bias for this week, and the fundamental confirms we are going to need, is the Fed to potentially confirm starting the tapering process or describing how robust and strong the economy has become, and that they're going to start to look to combat the high inflation, as well as stronger US economic data, which is going to come from the jobless claims, non-farm payroll, and unemployment rate. In my opinion, jobless claims is still going to be good in showing us less jobless claims overall. Unemployment rate is still going to be healthy and at pre-pandemic level points and still showing a slight decrease in unemployment. The non-farm payroll might be a little bit off, but overall the labor market in the US has been rebounding aggressively. So I am looking to start to play a US dollar bullish bias as long as we respect above 93.500 and 93 area. Even if we come to double bottom at this low created from last week as a potential price grab, I do see us making the upside potential to revisit these highs as intraday target points as long as we get those fundamental confirms alongside the price action and market structure. Okay? So when I'm zooming in here and looking at more of the intraday structure, you can see we had, in terms of looking at the actual candles, you can see we had this corrective bearish structure we could map out for an extended period of time. We had a pretty aggressive breakout, but this pullback that was at the end of last week and at the end of the month, where we fully corrected and had a stronger breakout to the upside, breaking above 94 and above the bearish corrective structure. So my anticipation now is that if we hold above 93.5 or 93.7 as potential retest points, that once we have our continuations up and more buy orders collected in the market, understanding that the US dollar is the world reserve currency, we can play that dollar strength accordingly when trading GBP USD, EURUSD, USDCAD, as well as for the short-term gold correlation as well. Okay? So besides potential dollar bulls as a safe haven currency and world reserve currency, which has primarily been influenced by stronger US macroeconomic data, as macroeconomic data has been back to pre-pandemic figures when we're looking at US PMIs, labor market data, retail sales, and so forth. The only thing that's been obviously off is the inflation, but that's been primarily induced by the Fed's massive money supply increase anyways. But they're calling, you know the Fed's, oh, supply chain issues, oh, COVID impact. It's because they exponentially increased the US money supply and printed 40% of the US dollars in all of history within the 2020 period. That's what led to inflation. You know what I mean? But they're not going to, they can't tell the general public that. But anyways, getting off topic there. So besides dollar being bullish, our other safe haven and market sentiment indicators like the Japanese yen and volatility index are still bearish overall in terms of structure and price action. So what I'm looking to primarily play is a bullish bias on the dollar, a bearish bias individually on the Japanese yen, and still playing the market optimism in the overall equity markets as investors look to squeeze out their gains towards the end of the fiscal year as we're entering the Christmas rally in another month. Okay? So overall market sentiment is still very optimistic besides the US dollar bulls, which we're going to be trading and using that accordingly to our advantage. Now, let's do some gold analysis. Gold on the higher time frames has been in this bearish corrective structure, giving us a repetition of the 2008 crisis period. I'm on the monthly chart right now. You can see during the 2008 crisis period, when we had mass fear, uncertainty, and doubt in the markets, we had interest rates low from the Feds, obviously, to support and stimulate the economy. We had an increase in money supply that led to an increase in inflation. So investors were pooling money into gold to hedge against inflation, also because of low interest rates and the economic fear. Gold went on a heavy rally to peak all-time highs at that point around the 1950s, 2000 price point. Similar thing, the 2019 and 2020 period, where we had low interest rates induced by Trump pressuring the Feds with trade war drama and so forth. We had the potential World War III, if you guys remember, before the pandemic started. Remember when we almost went to, not us, but the US almost went to war with Iran when Trump was still president? We had that going off, which was bringing some fear, uncertainty, and doubt to the markets. And then, of course, the pandemic. But the same thing and same actions from the central bank. The Fed was cutting interest rates at this time. Money supply was being increased. Inflation was going up. All bullish factors for gold. You can see you peak these all-time highs and then start to create some bearish corrective structure as you also create a very strong supply zone that you fail to break above multiple times, where at the same time you start to consolidate above a higher time frame demand zone as well. But as you recover from the economic crisis years later, and the Fed start to look at decreasing the stimulus and tapering the stimulus, the Fed start to look at and signal future rate hikes as well as combating the inflation, and US dollar strength picks up again, you can see you have multiple rejections at that supply zone. You respect the macro corrective bearish market structure, and you drive your way back down to that demand zone that has failed to break multiple times again as well. So the historical, fundamental, and technical repetition has literally been identical on gold compared to the 2008 period. What I'm looking at for us to complete this range down back to the demand zone is to get the Feds to confirm tapering starting, US dollar bulls, and continued US economic data rebound. Because if the Feds confirm this process of tapering to start, that's going to combat inflation, and obviously that's a bearish fundamental factor for gold. Tapering brings US dollar strength, which is a bearish fundamental factor for gold as we trade it against the US dollar. And if you have economic data rebounding, that is showing optimism in the US economy, and there's no reason for investors to be pooling money into gold as a safe haven precious metal. And we can expect that if we don't break these 1820 high points in this bearish market structure from a macro perspective, that we can make our way back down to the 1700s. And as the Feds into the next year start to confirm interest rate hikes schedule in the future, we have continued rebounding data. As long as the US does not go back into lockdown, we have continued rebounding economic data. The Feds taper stimulus support and start to give signals towards future rate hikes. I can see us coming down to 1700s, then entering this bearish market for an extended period of time until we have the next buy orders being collected at potential 1400s if we have another fear catalyst in the market, maybe 2024, 2025. Now, Obviously, this is higher time frame analysis. I'm just sharing you guys my 2 cents of how I view the markets. I am going to zoom in now to give you guys more intraday analysis, but it's always interesting to understand the technical and fundamental repetition across markets when you're looking at those previous historical examples. So does that make sense to everybody so far in terms of the technical and fundamental repetition, looking at the 2019 to 2021 period and to current day, and comparing it to 2008 crisis, but understanding behind the scenes of what the Federal Reserve was doing that led to this impact? Everybody good there? So what I want us to understand and everybody to understand is that right now, when I'm looking at the historical repetition as well as current market structure and price action, I'm seeing gold in this potential stage here, where as long as we don't break above the 1820s, I can see us start to drive down to these demand zone lows, at least at the 1680s, right? And now I'm going to zoom down the time frames and show you that more clearly, okay? So now let's look at the 4-hour structure overall on gold. And I want you guys to understand something here. I'm going to break this down for you. Overall bearish market structure from these highs. You have much stronger impulsive sellers drop moves. And then you have these aggressive pullback phases from the potential lows being printed that don't break the overall structure and just collect more sell orders before continuing down, right? Do you guys understand that so far as well? And now we're going to further dissect that. Look at this technical repetition. Every time you have a bullish trend, what happens when you consolidate and collect sell orders? And what we have going on right now too. I'm going to show you guys 2 scenarios that I showed the private channel as well. So look at this. Okay? We're going to break this down here. Okay, so look. You have bullish market structure from a low being respected for an extended period of time. Then you enter a higher time frame consolidation zone and order block where you create a clear supply zone at a historical price point. You fail to break that supply zone after consolidating as well, respecting a lower demand zone. And what you can see happen is, yes, you have this pullback that comes from these lows, right? But it doesn't break the overall integrity of the bearish market structure. It's a very aggressive pullback. Then you have these seller supply zones with a shit ton of sell orders and sell contracts being fulfilled. And once you break that demand zone low, you have the next impulsive move down. And then you get, again, a repeat of this. Then you enter a pullback stage. You have bullish market structure expected for an extended period of time. You fail to break a key seller supply zone with sell orders flooding the market. And as soon as you break that demand zone as well, you have an impulsive move to the downside, right? Here, you can see something similar across the board here. Supply zone rejected, 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 rejected. Impulsive move to the downside. Bullish market structure comes above here. Supply zone rejected, rejected, rejected. Impulsive move when you collect those sell orders and then break to the downside. Are you guys following that? So what I am seeing is sellers in control based on that monthly structure, the Fed's giving signals towards tapering, the same time US dollar's been stronger, the same time economic data in the US has been stronger as well. Yes, we get these very aggressive pullbacks from the lows, but that is just the way gold behaves in this overall structure. It does very aggressive pullbacks. The key takeaway is if we don't break those supply zones that get identified, that overall there's more sell orders flooding the market there, and we end up making our way back down to those low points. Do you understand? So yes, when we clear the screen, it can get very messy when gold is in these higher time frame consolidations. Price action can get messy, right? But as long as we don't break that sell order zone where sell orders are flooding the market and still respecting the integrity of the overall bearish market structure, you can see it's really just seller order flow collection, and with the fundamental catalyst, break to the downside. Seller order flow collection, break to the downside. Seller order flow collection, break to the downside. I'm seeing the same thing. We could come up to 1820 again, but if we don't and I could also see us coming up to 1820 to grab liquidity for FOMC, prior to FOMC. But if we don't break 1820s, I am still in potential macro sells to come down to 1760s and potentially lower. I am only switching my higher time frame macro bearish bias on gold to bulls if we literally break above 1830s. 1830s is my make or break price point to say, okay, you know what? Maybe I was wrong. The Fed said they're not going to taper yet. NFP and unemployment was completely shit. US dollar is weak. Gold breaks above 1830. Okay, then I can see upside to come back up to the 1900s. But if we don't have those fundamental confirms, if we don't have those technical confirms and breaks above 1820s and 1830s, then yes, even though we have been playing this gold in this range or been playing some of the short-term buys, in the back of my head, my macro bias and higher time frame main bias is still to start looking for potentially loading the sells. Because I'm overall still looking at that and looking at the previous diagram I laid out for you guys. Does that make sense for everybody in terms of the fundamental breakdown, technical breakdown? So yes, we might play some short-term buys up to retest 1812s, up to retest 1820s, but those are just short-term buys to set up for the better risk versus reward sells. Just like here, you could see gold went from these lows, ran thousands pips, then stayed in this range. Gold ran from these lows, ran thousands of pips, then stayed in this range. Gold ran from these lows, now it's been in this range. Gold ran from these lows, now it's been in this range. But as long as you respect the overall bearish market structure, as long as you don't break that institutional supply zone where sell orders flood the market, you can see at the end of the day, the main impulsive move is continuing with the trend to print a low or to revisit the previous low. Okay? But anyways, again, that's still some macro analysis. I just want you guys to be zoomed out and understand that perspective. And now we're going to show you guys some intraday trade ideas. Okay? So, let's get rid of this stuff because we're just going to be basing off the key levels and so forth, because I can see us potentially still coming up to the short-term upside, all right? So we still obviously have time until FOMC, until non-farm payroll and all that. That's still later in the week. So as long as gold holds above 1789 and 1781, I can still see buys up to revisit 1803s and 1812s to set up those high risk, high reward sells for potential FOMC. We could even go to 1820 for a liquidity grab, then see the massive sell-off afterwards. You know what I mean? As long as we get the fundamental confirms of Feds giving more signals or starting tapering, talking about future rate hike schedule, talking about economic data rebounding and so forth, and slowing down stimulus and US dollar strength, as well as stronger labor market data at the end of the week to complement what the Feds may say on the Wednesday. Okay, so in terms of trade ideas, I do see that if we can see some lower time frame bullish market structure, corrective structure developing here. If we just draw out a little trend line from this low to here. So these are some short-term trade ideas I see. If we hold above 1789, still I see buys up to 1803s. Break above 1795, still buys as well. Also above 1795 buys. Just because, remember, does everybody understand? We're playing the short-term pullback in buys up to retest those higher time frame sell areas. Is everybody following that, right? Because at the end of the day, we're not positional traders. We're not swing traders. We are day traders, scalpers, and like intraday traders, right? Most people are trading during a session or holding for a day or two max in our community, for example, right? So you don't want to start selling right now when we could see the potential sells at like the 1812s again, at the 1820s to set up for FOMC. For the intraday trade ideas for over Asian session, London session, and tomorrow, we're still going to play this bullish intraday structure that's being respected to potentially set up and collect more sell orders for FOMC, right? And then I'm going to start looking for sells at if we do reject 1803 or if we broke below 1781 and completely broke this structure. All right. But mainly I'm seeing if we can hold above 1789, even if we get a little bit of a deeper liquidity grab, then pop back above 1789. And my first area to start looking for some potential sells is the 1803 key level, but also I'm going to be looking for the at FOMC if we do come up to 1812s again. But until then, we can see US dollar for the time being, when we're looking at the US dollar as well. US dollar for the time being is just doing a little bit of a pullback for this new month and new week. So if US dollar still continues a bit bearish, comes down to 93.7, even 93.5 before continuing back up, then we can still use that to our advantage to play the short-term continuation buys on gold as a medium-term confluence as well. Okay? So yeah, it is going to be a hectic, busy week. FOMC, US economic data, start of a new month, coming towards the end of the year. So trade smart, trade accordingly. Remember, you are a manual retail trader and the market is always here. Doesn't matter if it's a pandemic, doesn't matter if it's a market crash, doesn't matter if it's a global lockdown, the market's always here. But guess what may not be? Your capital. So number one option as manual retail traders, protect your capital, pre-plan trade ideas, wait for those trade ideas, and follow strict risk management and high probability successful risk versus reward ratios, meaning at least look for 1 to 3 risk versus reward ratio trades so you can sacrifice like a 50% win rate on your trades and still be profitable, which takes off the pressure to perform, right? Takes off the pressure to perform. Also gives you room for error where in a stretch of 10 trades, even if you're going for 1 to 3 RR trades and you hit a 50% win rate, you're still gonna have that obviously profitability. So yeah, that's what I see on gold. Make sure you guys re-watch that, of course. Now, with the short-term dollar weakness, we can use this to our advantage, but we're still in a higher time frame bullish bias. So I'm expecting the dollar pullback to still continue to 93.7 or 93.5 and gonna play that accordingly as we can set up for potentially FOMC. before we see some further upside moves if we confirm the tapering, stronger economic data, no more lockdowns, which the US hasn't been in, and all those fundamental confirms I've been laying out in the other market update webinars as well. Okay, so for something like GBP USD, you can see a similar pattern. This is GBP USD on the higher time frame here and on the 4-hour chart. Because the US dollar is the world reserve currency and the global business currency, even though GBP might have strength against the yen, it is not going to hold that same strength against the dollar. Dollar overpowers any pair, any other currency in whatever pair it's in, because of that fundamental property of it being the world reserve currency, and especially with the massive increase in US money supply by the Feds. Okay, so overall, what you've seen on GBP USD is sellers enter the market and continuously take us to low points, with having intraday pullback phases the same time dollar index enters a pullback, this being a more aggressive pullback because October was the start of a new quarter. So we were really setting up new quarterly order flow moves with potential to still obviously target these lows. But what I would like to see the same time the US dollar is a bit weaker is us to get some GBP USD pullbacks to revisit this little order block you can identify that gets created every time we have a drop. I would love to get a retest of that area before continuing down overall. Okay, so US dollar on the macro perspective, and let me show you guys this example. Okay, look at this. See here how you see just simply on the line chart this GBP USD structure on the 4-hour. Everybody can see it's in a descending channel, right? With primarily sellers in control. Very easy to deduct there, right? But how we're going to validate the strength of the US dollar in this pair is if you look at the dollar index chart, which I was just showing you guys, it is the inverse of this for the most part, right? So that just goes to show you how dominant the US dollar is on a global scale. The GBP USD chart, for the most part, it's not a direct correlation, but it just shows you the strength of the US dollar as the world reserve currency, that when the US dollar is in an upside bullish phase and the buy orders are collected, you're going to see GU is primarily in bears. And then when the US dollar is in its bearish pullback, the same time, look, here you saw dollar print new highs at the start of October. Pretty much you saw dollar print new highs, right? Started the new quarter, start of October, dollar printed new highs, and then entered a bearish pullback phase to retest bearish market structure, correct? Same time, start of October, peaked highs, bearish pullback phase. Go back to GBP USD, start of October, peaked new lows, bullish pullback phase. It's the inverse. Do you understand? So once you can understand monitoring the US dollar movement and its fundamental value, you can play that correlation so well. So what we can see here on GBP USD is that we are starting to get a clean break of this pullback structure from those lows that we were playing for that month. The same time dollar was in a bearish pullback, and every single day we were monitoring this bearish pullback on the dollar, we were playing GBP USD buys, okay? But now we can anticipate that after we collected more buy orders at a demanded price point of interest, we're potentially showing a shift out of structure here. Even if we hold above 93.5 like I'm showing you guys, we still have a lot of bullish potential to revisit these highs. I would only be in a bearish bias on the dollar if we broke below 93 flat and came well below the previous highs and had fundamental confluence for that. Maybe FOMC goes exactly the opposite, as I said, because at the end of the day, I'm not a fortune teller. I'm not a magician. I'm just somebody with experience, knowledge in fundamentals and technicals, as well as macroeconomics. And I like to bring it all together with the price action and analysis for everybody to view. But if I was a fortune teller, if I knew exactly what was going to be going on, I wouldn't be sitting here. I'd be on some remote island jerking my dick. You know what I mean? But anyways, so the only way I'm switching out of this bullish bias now on the dollar is if we break below 93 flat. Otherwise, what I'm expecting for the new month, as we're just starting the new monthly candle, right? October just started, is pullback, continuations up, right? So when I'm looking at GBP USD, if we break above 1.368, I can see some short-term pullbacks and buys. You can take buys if we break above 1.368 to set up some potential higher risk, higher reward sells and continue down. Only buys as a pullback buy for 368, up roughly 40 pips. And here I'd be watching for sells, but if we dig a bit higher, I wouldn't buy. I would just be looking for sells here at the next medium term zone. Or if we just have US dollar strength come back into the table, sells on GBP USD below the current lows with a breakout at 365. Okay. Now, let's go on to EURUSD, which is going to be similar as well. EURUSD is not exactly the inverse of the dollar index, but as the European Central Bank has kept stimulus more active compared to the other central banks like the Feds, Bank of England, or Bank of Canada, we've seen the euro a lot softer against the US dollar, and obviously US dollar strength has been coming back into the table. And even though it's not as clean, you can see the primary structure from these high points has been sellers in control, with sellers printing lows, having very aggressive pullback phases, but still overall continuing to the downside, right? You can see when you're looking to the left as well, we're at a very strong higher time frame demand zone that we broke below. The same time, we are starting to anticipate a lot more dollar strength that can come into the table. The intraday time frames here are getting a bit messy as we have created a double bottom at 1.522. But this is still what I see when I'm looking at EURUSD. If we hold above these medium-term zones marked out, I can see some potential again, just like GBP USD, but euro has been overall a lot weaker compared to GBP, especially against the dollar. I can see short-term buy scalps to set up better risk versus reward sells. So if we hold above this medium-term zone at 1.60 flat, and US dollar is still a bit bearish in the intraday time frames, I'd be looking for sells at a double top rejection of previous lows, higher time frame key level 1.1685. Even if we go a bit higher and then come back below, I'd be looking for those sells. Or if we cleanly break below these lows and come below 1.15100. The buys on GBP USD and EURUSD are just primarily pullback buys, playing some potential scalp buys if we hold the current structure in the sense of US dollar just being a bit more bearish. Because remember, even though we're bullish on the dollar, we can still see some heavy price grabs because obviously we have FOMC, and with the Fed interest rates, you see heavy liquidity grabs. Like dollar could come to like 93, but then reject and bounce and continue back up bullish. So in the short term, I do see that dollar can come to double bottom at these lows in the new monthly candle before continuing back up bullish if we get those fundamental confirms of the Fed's starting tapering and stronger US economic data, or any future interest rate hike schedules or talks about that and them saying, okay, the economy is more robust, more people are getting vaccinated, we're in a better place than we were a year ago, yada yada, we're going to start combating inflation. Okay, so in the short term though, we're going to be watching these areas of interest on the dollar to set up those better risk versus reward buys. That's why I can see a potential GU pullback if we break above here, just to again set up the better risk versus reward sells. And the same idea here with EURUSD. Okay. And obviously gold trade ideas shared at the start of this webinar. Now, USDCAD is going to be a bit more of the inverse, because we can see that last week this spike down, for anybody who's wondering, was from, so anyways, let's start from before that. We can see the same time that dollar has been in this pullback structure from these highs at the start of October. Obviously USDCAD, with the US dollar as the primary and the Canadian dollar as a secondary, from October period has been in this bearish market structure, right? And now we had a double whammy on USDCAD, because a bullish fundamental factor for the Canadian dollar is crude oil being extremely bullish, which it has been. Oil's been sitting at like the $80 barrel price point. So for the month of October, dollar was in bearish pullback and bearish for the time being. Oil was extremely bullish, going on a heavy rally. So you had US dollar weakness, Canadian dollar strength, and this one-sided market volatility as we went to print these lows at 1.23200. Okay, now we're in a consolidation phase, but what's very interesting is that US dollar weakness is starting to subside, and even when even when the Canadian dollar picked up a lot of strength from the Bank of Canada sentiment, which was this move, this aggressive spike down here was when the Bank of Canada, during their policy statement, announced that they're going to start reversing the quantitative easing. They're going to slow down the quantitative easing, right? You can see that brought a lot of Canadian dollar strength in the short term. But even with that strength, we still didn't break these lows printed, and it seemed like more of a liquidity grab to set up high risk, high reward buys. So when I'm looking at UCAD in this range, the easiest thing is just to play and understand the consolidation, with 23200 being a make or break price point. If we still have intraday candle closures, meaning hourly and 30-minute closures above this price point, I would still be looking for high risk, high reward buys, because I can still see the US dollar just doing a little bit of a pullback. Or if we break above 1.24, I also see buys on UCAD above 1.24 key level and a breakout of the consolidation zone and order block. I'd only be looking for sells with clean breaks below 1.23 flat below these wicks, with confirmed fundamentals that would validate US dollar weakness on the higher time frame. Otherwise, on UCAD, I'm in a bit more of a bullish bias if we can confirm the dollar bulls, and as well as the Bank of Canada sentiment getting waved out. On GU on the higher time frame, I'm in a bearish bias, just looking for short-term pullback buys to set up better long-term sells. Same thing for EURUSD, same thing for gold with that full breakdown I gave you guys on gold. Okay? Now, that was just going through gold, precious metal commodity, GBP USD, EURUSD, which is primarily influenced by the US dollar as the world reserve currency, which I broke down to you guys, and then USDCAD, which we're using the correlation of crude oil and the dollar, as well as market structure and the fundamentals to come, and breaking down the Bank of Canada impact, how it wasn't enough to break these lows and it got faded out. GJ now is a different story when we're looking at the higher time frames, okay? GJ is extremely bullish because individually the Japanese yen has been extremely bearish, and the Bank of Japan and Japanese economy wants the Japanese yen bearish. It's better for their import and export, and it's better for their economy as their debt system is structured differently, and they are already used to negative interest rates and stay in negative interest rates. So when you're looking at overall Japanese yen individually on this is the Japanese yen currency index, you can see it's just been bearish, right? So all we've had is up like quick little pullback plays, pullbacks and continuations down. Consolidation zone, break to the downside. Pullback play, break to the downside. Now we're consolidating at new lows, but my anticipation is that this is a seller's order block and seller's consolidation to break out even deeper to the downside. Okay? So I'm looking to still play that Japanese yen weakness. Even though I know GJ has been a bit softer, you have to keep in mind it's the start of a fresh new month and the fresh new monthly candle setting up, right? So as long as Japanese yen individually stays below 88.3 and below this consolidation zone, I can't look for any GJ sells. I'm still looking for GJ buys, anticipating that we can consolidate but potentially break out to the downside, right? Japanese yen is just ranging and GJ isn't dropping aggressively. GJ is just doing a pullback from highs printed for the new month, which I'm going to explain to you. All right. So now look at GJ here. All you've had for the last year and a half on GJ with that fundamental macro Japanese yen weakness is bullish upside moves, buyers print highs, pullback phases, and continuations to the upside. That's all you've had, right? You can see from this demand zone here, and based on the daily price action, we had a very strong consolidation period the same time that Japanese yen was ranging here. See the same time that yen was in this higher time frame range here? That's the same time that GJ was also doing a pullback from its highs. Just because the market may be in a pullback phase doesn't mean it's aggressively dropping, right? The market moves in phases. You can see we had this high printed, a pullback phase that extended for months, didn't break this higher time frame demand zone, which almost went to go revisit these previous highs, collected a lot more buy orders and had extremely strong bullish price action for the month of October with straight bulls printing new highs above the previous highs, right? So now, as we had this aggressive bullish upside move, it's not out of the ordinary to see a pullback phase. Does that make sense? GJ is just simply in a pullback phase from those new highs being printed to go back down to a more favorable demand zone to collect more buy orders. And especially you have to understand that it's a new month, so you're getting the new monthly order flow setup. But when you're looking at GJ here, the monthly is extremely bullish. Very strong bullish price action, high printed, pullback phase. You had 4 months of bearish price action engulfed in this last monthly candle. So it's okay. This new monthly candle is just making its lower wick. It's just collecting more buy orders to potentially continue right back up. Nothing just continuously goes up forever. That's not how the market works. The market is constant transactions between buyers and sellers, money moving from hand to hand. For a buyer to exit the market and the people that actually impact the market, the big boys, the smart money, the market whales, whatever you want to call them, there has to be an order on the other side to relieve them out. That's what creates these pullback phases, technically, that we observe. Okay? So we can see that on the intraday time frames from this, we had such a strong bullish rally with minimal pullbacks from that 148 and 149 demand zone, that from this high printed, we're just entering a pullback phase. That's it. Okay? I'm still primarily bullish as well on GJ2. So what I'm looking at is 155.8 as a make or break area. Okay? If we still hold above 155.8, I'm still looking to scale buys in accordingly, at least to retest this bearish market structure and potentially break out higher. All right. I'm still primarily just been playing the higher time frame buys. I wait for the pullbacks, jump back in the buys, but we've been in a higher time frame pullback just for the new monthly candle. So if we hold if we hold 155.8, break above 156, 156.2, I'm looking for buys in these areas still. Okay? I'm only selling with clean intraday candle closures below 155.7 or safer below 155.5. Or like this. So if we hold this current level and break up, but reject 156.5, maybe a short-term sell there before we do something like this. But otherwise, my main bias is still buys, with the green boxes being potential buy zones at Asian session if we still hold this area. Maybe a potential pullback from the retest of bearish corrective structure, but still potentially to set up buy continuation moves or breakout above 156.5 buys. The only thing we have to keep in mind is that the new monthly candle is just doing its pullback. I would only sell below the lows or below 155.5. Right? Anybody who's a capital hungry OG knows for the last year and a half, all I've been telling you guys is wait for when the pullback phases on GJ happen. That's perfectly fine, right? But for the last year and a half, all you've had to do was wait for the pullback and buy from the demand zone, or wait for the breakout of the highs and buy at the breakout. Just because Japanese yen has been weaker, GBP has been stronger than the yen due to the fundamentals I've been describing to you guys for months. Right? It's no different here. All we've had is a very aggressive, impulsive upside move from this demand zone, breaking above that corrective structure. Extremely strong rally for that last 3 weeks. So now we're seeing some profit taking by buyers in a pullback phase. Just because we're in a pullback phase doesn't mean you want to start instantly looking for higher time frame sells or think a full reversal is going to happen, right? Exactly. And last but not least, US 30 stock market index. Same analysis can be applied to NASDAQ, S&P 500, whatever it may be. We've been, same idea. We have not been fighting the Federal Reserve, where the Federal Reserve exponentially increased the money supply after this crash point and then started flooding and injecting the markets. And all we've seen is pullback continuations up on the stock market as the 1%ers and market whales extend their generational wealth, and every single crisis is an opportunity for the ultra rich, right? So that's just a quick little breakdown there. But we can see that we're still looking to play this bullish market structure when we're zooming in here. The new daily candle, I'm looking at 35,850 and 35,720 as buy areas to extend us back up to these all-time highs and potentially higher, going to 36,000 plus. We don't have any fear, uncertainty, or doubt in the markets to shake stock market investors out of their gains. And even with tapering and rate hikes, the stock market and housing market in the US economy will be the last to be hit. Other commodities will see the sell side liquidity enter there first. And I can really see stock market buyers extending their gains to end off this year, end off the fiscal year, going into the holiday rally and the Christmas rally, they call it. Okay. Okay, everybody, thank you for watching. That was the Monday Market Analysis webinar, where we did an analysis on fundamentals, economic events, technicals and higher time frame, breakdowns on gold, GBP USD, EURUSD, USDCAD, GBPJPY, and US 30, while also looking at individual movement on the dollar, Japanese yen, and equities. Okay, make sure you guys like, subscribe, and share for more. Also, for anybody who wants to learn more, make sure you follow all of the Capital Hungry resources. You have the Capital Hungry YouTube page. where you have all these various playlists on scalping, educational webinars, Monday market update webinars, self-development live videos like I just did on 3 days ago about like fear, discipline, and consistency. You can learn a lot from the hundreds of videos on the YouTube page, right? You also have the Capital Hungry News Twitter, which posts over almost 25,000 headlines already. You can also see the Capital Hungry business license if you want to join the private channel. You know what I mean? Most of you guys are in signal groups that aren't even a registered business, some mentor. But you can come see all these, you can follow for headlines and stuff here. Capital Hungry free Telegram analysis channel, where you can see like trades I take, chart updates, news headlines, information, and so forth. And if you want more than the free content and you want to be a part of a more private membership community where we do 5 New York scalping sessions a week, London scalping sessions, market update and trade idea webinars like this every single agent session every day, you get access to this newsroom. You get access to the trade room with market session alerts, market monitor, key level price alerts, other members sharing their analysis, me sharing charts, Zoom sessions, and so forth. Access to the newsroom. You get access to the crypto newsroom. You get access to the 50+ educational webinars. You get access to the weekly recap webinars, Zoom sessions, Monday market analysis, fundamental points, weekly economic events report, right? If you want access to the private channel, then make sure you check out the Capital Hungry website, where it's a monthly fee. It's no one-time big cost. You can join for the month and pay for the month. If you don't like the service and don't feel like you got the value, you can simply cancel afterwards. You only pay the $100 for the month. And if you don't like it after the 30 days, then you can just cancel like a Netflix subscription and never come back. But the majority of people end up staying, and we've kept over 300+ members for almost 2 to 3 years now. So you can see everything that you get access to there if you want to learn more and deeper. Otherwise, before that, make sure to check out all of your free resources. I don't know any other service out there that has this many free resources. From the webinars, educational webinars, trading streams, news headlines, Telegram analysis channel. But if you want 10 times more than that, then come check out the Capital Hungry private channel community, where we are always active, always sharing trade ideas, bantering, analysis. You can come join the trade room. There's way too much shit for me to describe, all right, within the Capital Hungry private channel. There's too much stuff. Most people end up staying. It's up to you if you want to join. Other than that, make sure you check out the description for all of your free resource links. For anybody who's asking about what broker to sign up, there's some broker suggestions there as well. I'll see everybody on Wednesday for the live scalping session on Wednesday morning, 7 a.m. Eastern, New York scalping session. Thank you, everybody. If you enjoy these, send a like, subscribe, and I will see you guys Wednesday morning, 7 a.m. Eastern, this YouTube channel, scalping session. All right? Take care, everybody.